Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi, welcome back. Well, Shree Cement is really the stock on our radar. It took a knock post what looked like a weak set of numbers. Then it recovered after CNBC TV18's clarification that the other expenditure included a large forex loss. If you adjust for that loss, the margins were not as disappointing as earlier thought. In fact, our colleague Nigel was talking about this yesterday, and ever since that clarification came through, the stock has surged about 3.5%. HM Bangur, the MD of Shree Cement, joins us now to talk about that. Mr. Bangur, good morning. Of course, we do have that clarification on the other expenses. It includes the forex loss, etc. But let's start by talking about the top line itself. You know, the realizations this time have been hit because of the exposure that you have to the North Indian market. The sales growth has been good, almost about 90% or so. But tell us what the expectation is going ahead. The volumes at about 7 million tons, do you think that's something that you could sustain over the next few quarters as well? How is demand shaping up?
Demand is shaping up very well. This is an election year, so the demand growth will be more than normal. And as you have seen, 19% growth is there. So we have entered some new markets which were not our traditional market. Yeah. And in the process, a little bit realization also have come down. Freight also have increased. But this will recover as it was the new market. Things were not normalized. Our dealership network was new. So gradually the realizations will increase and the volumes also will be robust. We expect better times ahead as good demand year. This is a good demand year.
Okay. Good morning, Mr. Bangur. Can you explain this FX loss? Is it a one-off? Will it recur? Why did it happen?
This is a FX loss, but we had purchased a unit in Russell Khema for roughly $300 million. Now, out of those $300 million, $250 million were sent from here. We had taken the loan for our other expansion here, but then as we have exposure in Middle East in dollar terms, we wanted to keep same amount of dollar exposure unhedged, so that dollar to dollar itself will be hedged. So in a way, it is a one-off, and covering it would have been risking ourselves. It is a peculiar case where de-risking is better.
So what could the adjusted margins be for the company over the next few quarters?
Margins is a matter of sales rate, but we expect sales rates to be good. Costing will be in control. Margins, it will be difficult to predict.
No, you've been doing 21, 22. See, if we took off this FX issue, then this quarter as well, you have done over 21%. So is that the broad ballpark?
Yes, it should be a little better only, if not the same.
Okay. Has the petcoke usage stabilized now? No more issues?
Now, petcoke is an overhyped subject. It was very relevant 10 years back. Now, petcoke prices and coal prices are differing by 2 to 3% only. Company has everywhere full flexibility to use either petcoke or coal.
I see.
And many of times coal is cheaper. So right now we are using roughly 40% coal and 60% petcoke as it is.
Okay. What were the realizations in this quarter? What was the exact realizations, and what can we expect over the next few quarters?
Realization was about 3,900 rupees instead of 4,100 rupees last time, roughly 5% lower. Going forward, we can expect a better realization than this. As I was saying, our margins will increase, and such low realizations and low margins are not going to remain. Sometimes it has to be passed on to consumer.
Okay. So you should expect a rise in prices is what you're saying?
Yes, I say.
Okay. Mr. Bangur, you know, the sales volume is actually a lot of companies have surprised us with higher than expected sales volume. Can you give us an idea of how the demand is looking like right now? We are in monsoon, but even comparing monsoon to monsoon, is it better? Are you expecting it to be better?
Definitely it is better. Now, Government of India is doing many of the infrastructure projects, 500 to 1,000 crore rupees, where a lot of cement is needed, and that demand is coming and not much noise is being made. So everywhere, this is an election year, as I was saying.
Yes.
Demand will be good, infrastructure growth is good, government expenditure is good, and monsoon to monsoon also, demand rise will be substantial. Normally, the cement demand rises by 7 to 8%. This year, it will be in double digit.
What is the geographic breakup of this demand growth? Where is it better? Where is it not so good?
Demand growth is there all throughout India. For us, because of low base in East, our East demand, sales increase is about 35%, while North is only 12%. But 12%, I have to say, only, even though it is a double-digit growth.
Yeah, I agree.
Okay. So just one more question, clarification. Two costs for you. The freight costs, which rose about 14% this time because of higher diesel prices, and employee costs, which rose because of the manpower that you hired for the Karnataka plant. Should we expect these costs to continue?
Yes, the cost will continue, but as a percentage of revenue, it will come down. As Karnataka plant is expected to start somewhere by September end. So, for 3 to 6 months, these costs will be there. Gradually, the volumes in these Karnataka plants and the other units will pick up, and these will come down as a percentage of sales, or they will remain the same.
Okay. Can you give us an idea of how much better demand will be? I mean, I know it's asking a tough number, but still your best guess in terms of volume growth for the year.
I was expecting more than 10% for the industry as a whole, and Shree Cement should be doing a little better than that.
All right. And what about EBITDA per ton? Even this is sustainable? I mean, what is that, 850?
This EBITDA per ton this quarter should be bettered in all subsequent quarters this year.
Okay.
That's a strong statement.
Just one more question. You know, these axle load norms have been changed. Now overloading, you know, can be done, etc. Any analysis of how this could help you, or it could impact the cement industry at all?
Now, overloading cannot be done. The new norms for loading has been fixed. So it will be always within the norms, the loading will be done.
Okay.
And secondly, these will make the competitive, the cement will be available, competitive, nation will be saving a lot of diesel. It is good in all respect.
All right. Thank you very much, Mr. Bangur, for joining us with your thoughts on several aspects of your company and the cement industry. We move over just for a bit to commodities as well. The markets have opened and we would like to know the early trades. Manisha joins us. Good morning again, Manisha. What are the trends?
Well, thank you so much for that, Lata. After 2% gains overnight for the crude oil prices, Asia has opened 1/4 to 0.5% on the weaker side. So net, we still are trading in the positive. We've seen 70 come back for the US crude, and 75 or thereabouts is where the Brent is also trading. The pressure, of course, comes in on the back of the OPEC supplies, which have increased by 70,000 barrels per day for the month of July. This is the highest increase in OPEC supplies in 2018, and that really seems to be putting some pressure. But we're not looking at a complete sell-off here, because you have seen supply concerns come in from Middle East, from Canada as well. And the markets also are looking at numbers wherein you have seen that the global inventories are off their 2017 highs, and that continues to support those prices. Having said that, the last day of July and in this month, we have seen nearly 5% of a decline come in for both the crude varieties, approximate that number. The gold and silver prices, well, this is a 5th straight month that we are closing in negative, couple of percentage points down for both of those metals there. The strength in US dollar and almost absent physical buying in the consumer countries is something that continues to weigh there. The base metal prices, in the meanwhile, also seem to be tackling with some issues. It has been about the US-China trade concerns, the strength in US dollar, the oversupply in some of these metals, and of course the Chinese data, which hasn't been up to the mark, continues to weigh here. So the copper prices, we've seen a constant decline on that, is down by nearly 6% for the month of July. The worst performance, of course, comes in from zinc, which is down by 12% in this month. This is the worst monthly decline that we have seen since September 2011 for the zinc prices. Ditto for the other metals as well. Nickel continues to decline. Lead actually has declined by 11% as well in this month. But in the zinc prices, and that is the only one that really stands out in the Asian markets now, and we are looking at some short covering coming in for that. And that's exactly what we are hearing from brokerages as well today. We spoke to Grow Value, and they have come out with a buy call in case of zinc. They are looking at targets of 182 rupees per kg on the higher side for that one. A sell call, though, in the energy space, and for the natural gas prices, they have a sell with targets of 185 for the day.
At the moment, markets still in the red, 0.25% lower. Mid-caps have done well. And it's about over one stock in the green for one in the red. So about 1.3 stocks in the green for one in the red. Banks are seeing profit taking. It's not a huge amount of profit taking, but red there is on the screen. 68 points down on that index, or 0.25%. But at the moment, we are looking at another stock, Aptech, and that stock is actually higher. Q1 was not fireworks. Revenue was flat, but lower employee expenses has aided at the EBITDA level. The non-retail business has also posted a loss. Anil Pant, Managing Director and CEO of Aptech, joins us now. Good morning, Anil. Thank you very much for dropping by in the studio. Well, can you take us through the numbers? Revenue's flat. I mean, is there a one-off here, or is business tough?
So, Lata, this is actually optical in nature.
Oh, really?
The reason I'm saying it's optical is about 2 years ago, we decided that a lot of low-margin businesses, we would exit from them.
Okay.
Right? And if you look at the profitability, I mean, in terms of manpower, you're saying lower manpower expenses, but we've actually had a net addition of 90 people in the organization.
In the quarter on quarter?
Year on year.
Okay.
The 90 people that we've added in the organization.
Okay.
So it's the manpower expenses have gone up. It's just that some of the businesses which were very, very low margin and amounting to almost about 8.5-9 crores in Q1, we've not done that. And that is a conscious strategy of the organization. We'll continue to remain in high margin
table
businesses.
said that employee expenses was 19.57 crores year ago quarter. It is 16.8 crores now.
No, this is probably because of the ESOP expenses impact.
Fair enough.
So tell us about the business itself. What was the enrollment growth that you saw in this quarter? What's the expectation going ahead?
The interesting thing is the extremely high growth that we are seeing in our media and entertainment space.
Okay.
Which is basically the brands like Arena and Mac, where we teach animation, VFX, gaming.
Okay.
Well, that is growing at almost about a 30-35% year on year. The computer education part of it is more or less flat. Aviation is growing. And the beauty business is doing very well. I mean, the centers that we've opened with Lakme, you know, the Lakme Academies, we've got about 50 functional now across the country, about 100 signed up.
Okay.
That's doing very well.
All right. What is the revenue visibility, therefore, in retail, non-retail?
So, in terms of revenue, we're looking at a real growth of 30%. And when I say about a real growth of 30%, I mean after netting off the low margin businesses.
Okay.
The good businesses will grow by about 30%. And profitability will continue to grow at the levels that you're seeing it growing at.
Okay, so in terms of these animation courses, which you said is a high growth space, the beauty space as well, what kind of growth do you hope to see there? And any other verticals that are picking up now?
So these are the main lines of businesses for Aptech. Our international business is again doing extremely well. We've got almost about 60,000 students across the world, other than India. And there are lines of businesses that we are starting. You know, there are a few universities which are very eager to tie up with us and offer a lateral entry into their final year of education to our students.
And what basically causes these animation courses?
The animation courses. And Lata, look at it. I mean, it's at the end of the day, it's creating content, right? And if you go 10 years back, you would have found one screen in the house, everybody sharing content on that one screen. Today, every house has multiple screens. Your phone is a screen, laptop, iPad. And content is what is getting consumed at an amazingly rapid pace.
How much does these animation segment contribute to your revenue?
Oh, this is almost about 40% of our revenues today. the animation courses. Your own studio hires a lot of people from our centers.
No, I would imagine.
Okay. Any acquisitions that you would be looking at to broaden your business?
So we're looking at a few acquisitions, but again, we're looking at valuations of these acquisitions very carefully. No point putting money blindly into something that may or may not work out. So we're looking at a few, but we will be extremely careful before we sort of
so for the animation foray, you acquired a company, MAC, right?
Maya Academy of Advanced Cinematics.
You paid about 76 crores for that. You have any war chest? I mean, what's the cash on the books? How much would you look at for future acquisitions?
So we've got about 55 crores of cash on the books. We're a debt-free company, right? And we generate free cash flow. No need of going to the banks. And we're adequately well capitalized. And we have enough money to look at acquisitions if we need to.
Okay, you have two big promoters. I mean, for the stock market, they are very big guys, RJ and RK Dawani. Do they advise you? I mean,
so
how helpful is it to have them as promoters?
It is such a dream having a person like RJ as your chairman, because the kind of inputs that you get from him, people would actually pay to get advice, right?
Okay.
And he's an amazing boss because he gives you complete freedom. I mean, it's a professionally run company. And his inputs are, I mean, at times he just looks at numbers and comes up with some real great
What's
inputs.
the latest advice now?
The latest, so I mean, he was very happy with the fact that we are exiting the low margin businesses and concentrating on the, and he was spending
But how
a lot of
long
time
will
on
this
that.
drag last on the top line of low margin? At what point does it?
Maybe another quarter, Lata. Because a lot of it we've already sort of absorbed, and maybe one more quarter, Q2 again maybe slightly flat, but then onwards we should be able to see significant growth.
All right. Anil Pant, it was a pleasure having you with us.
Thank you very much.
Thank you very much for joining
Thank you very much. Thank you very much.
Thanks for joining
Thanks
us.
again.
Okay, well, that's the word coming in from Aptech. By the way, the street liked what it heard. The stock is up almost 3.5% right now. Can't say the same over the market because the market is under a bit of pressure right now. So the Nifty is down about 0.3%. But as we wind down on Bazaar, we will leave you with some thoughts from the CNBC TV18 Citizens MPC on the impact of liquidity and yields and how it may influence the rate decision that comes out tomorrow from the RBI. Thanks for watching.
That's difficult to say. I think that, there are two contradictory forces in operation. The first, of course, is that I think the banking sector is starting to come out of the funk it has been in a while. So that's a plus. The minus is that trade wars now look very much more likely, which means that the external effect is going to be far weaker than one had hoped. So it's a little difficult to say, but I would actually moderate my growth expectations at this moment.
Okay, so that won't be a very hawkish factor. Would you agree, Samiran, would you say that growth will not be as much of a hawkish factor as it was?
I mean, if you look at last half of FY18 and early part of FY19, we are coming off a low base of demonetization and GST-related disruptions. In fact, the July-September quarter, in some sense, will probably be the first clean quarter without these base effects. And we need to see how the growth numbers hold up for this quarter. Our sense is that the 7.7 that we have seen is probably close to the peak for FY19. So from here on, we would see some moderation in growth numbers.
But Soumya, if you can put the external piece in context, we have had trade wars mentioned, we have had crude mentioned, but how should the MPC parse all the pieces?
See, I believe that the external sector is actually a matter of concern, because if you look into the US-China trade wars, and as Sajid was saying, yes, US is possibly going to hit a growth rate of 4%. The ECB could actually end tightening towards the end of this year. But you have to also juxtapose the factor that the wages are actually being significantly depressed in US and across the world for the last couple of years. I think that the US possibly is also veering towards a less of aggressive rate hikes in 2019, even though a September rate hike could be a possibility. My sense is that exports are unlikely to push up growth to domestic growth to a significant extent, and domestic demand as of now doesn't look entirely promising.
Well, what about liquidity, Sajid? Would you worry that, anyway borrowing is going to be higher in the second quarter? So that perhaps is going to take care of yields, push up yields, or at least not allow yields to fall. Therefore, need the MPC hike at all? Because the market is going to take care of that.
I think on the liquidity front, the policy is quite clear that durable outflows in liquidity will be met by durable injections. What's notable is between January and June, currency in circulation has been surging, growing at 40% over last year for a variety of different reasons. If that pace continues, and given the pace of BOP intervention we've seen, you may require anywhere from, 2 trillion of base money to be injected in this fiscal year. Now, if the RBI is selling dollars to prevent more depreciation, the only way to inject that is through open market operations. And I think that's why you've begun to see this systematic plan where every month there's one OMO being done. I think if currency in circulation continues at this pace, the pace of OMOs in the second half of the year may have to increase to meet those liquidity requirements, which from the bond market's perspective provides some relief. So the tug of war will be, on the one hand, borrowing in the second half is higher. You could have some fiscal slippage from the state perspective, but offset a little bit by the OMOs the RBI will need to do to stick to its liquidity policy of keeping liquidity close to neutral.
So it will keep liquidity neutral?
Close to neutral.